Good afternoon, everyone. I'd like to welcome you to the first quarter update from HNB. Today, I have here with me our Chief Operating Officer, Sanjay Vijayaman, Chief Growth Officer, Bimal Pereira, Chief Financial Officer, Anuradhi Dalage, and I'm Priyanka. Unfortunately, our Chief Executive Officer, Damit Vallewati, is not in a position to be here with us today. So we'll start our update by going through the presentation on our performance, and then we'll move on to Q&A. So moving on. So as you know, with the interest rates coming down over the period, what we've seen is that the private sector credit growth has continued to pick up over the last 12 months. So on average, what we've seen is the private sector credit growth has recorded a 14% growth. So at HNB, year on year, we've seen a 15.5% growth in advances, which is 158 billion or almost 160 billion during the 12 months. During the first quarter, what we've reported is around 14.4 billion. So despite this growth, the reduction in yields has resulted in our interest income dropping by about 10.5% during the quarter. But going into interest expense, the same reduction in interest rates as well as focus into growing CASA, especially over the past, has resulted in our interest expense dropping at a faster pace. So with this, our NII has recorded a 10% growth during the first quarter. And looking at the NIMs, what you see is that NIMs are being more or less normalized around 4.8% level. So first quarter was 4.8%. If you look at the graph in the middle, what you would see is that fourth quarter, the margins were relatively high, but this is mainly because the fourth quarter had an exceptional impact because of the ISPs. So more or less, margins are getting normalized now. And then moving on, the fee income level, like we've seen quite a good growth at about 23% during the quarter. And this growth has come by way of mainly digital channels. So e-banking, ATMs, cards have contributed well to this growth. And as we've seen in the past, despite a very healthy growth in trade volumes, the trade income has dropped because of the tariffs. And on the other income side, with the currency depreciating, we've seen a gain in the first quarter as against the loss that we reported in Q1 2024. On the insurance side, at the group level, insurance income also had seen a good growth of about 25%. And in effect, our TOI has seen a 27% growth, standing at around 41 billion for the first quarter. So moving on to impairment, unlike in the previous quarters, now what we've seen is that on one side, in the last few quarters or last couple of years, what we saw was that the banking sector was making significant impairment provisions on account of financial assets. So that has basically more or less come to a very marginal level now. So that reduction, together with the positive movement that we've seen in our portfolios, has resulted in impairment reversal in the first quarter. So overall, if you look at our asset quality levels in terms of stage 3 ratio, net stage 3 ratio, as well as stage 3 provision cover, I think we've recorded one of the best ratios in the industry. Moving on to expenses, at an overall level, our group expenses have grown at around 16%. General low expenses or overheads have grown by around only 5.7%. There's an increase coming on the insurance side of about 23%, but there is a corresponding entry or an income getting replicated on account of these costs. On the personal expenses side, if you look at it, okay, there's a 23% growth. On here, one thing to note is that in 2024, the collective agreement, the impact came in the second quarter of 24 only. So you have that impact coming on to 2025, and it was on there in 24 first quarter. So that's one reason. The other reason is that the exercise that we've done in terms of realigning the compensation and benefit of our staff. So moving on, overall, what we've seen is that the taxes have more or less increased with the growth in profits, and in line, the group PAT has grown by about 49%, with PAT at 11 billion. If you look at the soundness indicators in terms of liquidity, I think our LCR, NSFR, all are well above the regulatory minimum levels, with all currency LCR at over 3.5 times more than the regulatory requirement. NSFR at 160% against the 100%. Capital adequacy levels, I think we are one of the best capitalized banks in the country, with buffers of over 800 basis points in terms of both Tier 1 and total capital. And moving on. So if you may look at the areas which had contributed to the improvement in our ROA and ROE, what we see is that NII has remained more or less at the same level. Other income, as I mentioned earlier, with fee income, exchange income, and insurance income has contributed to the growth, and also the impairment reversal as opposed to the impairment charge that we recognized in the last year has enabled this improvement in our ROEs. And finally, if we look at some of the key awards that we've got, just to highlight, one is being recognized as the top or the number one corporate in Sri Lanka by Business Today, and then we've been recognized by Asian Bank of the 15th time as the best retail bank in Sri Lanka. So I'm not going to go through the entire list. Now I would like to open up for any questions that you may have.
Priyanka, if I may ask, I'm Bimani from CTCLSA. On a quarter-on-quarter basis, if you look at the loan book, it's pretty flat. And particularly if you look at the decomposition of the loan growth, there is a degrowth on the foreign segment, where a few of the other banks have sort of lent in terms of overseas, loans disbursement. If you can just touch on those two elements, plus in terms of the personal expenses, since would there be a April hike, and would there, is there a April hike as well in terms of salary cost, and what would be the likely impact in terms of the ratios?
So Sanjay would come on the first part of the question, Bimani.
So on the loan side, basically, you're right, on the foreign currency, we had a couple of large settlements. So there is a degrowth there versus competition. But on the LKR side, we have seen good growth on a couple of the segments. We had a little bit of pressure in the corporate banking side, and that was because of very aggressive and low pricing. So we opted not to do some of the deals at those prices. But essentially, we are looking at very aggressive growth on the loan book for the next few quarters. But yeah, the large settlement on the FCY and a couple of pricing deals that we let go is what has caused that sort of flat loan book for Q1.
On the second part, Anurag will come, Bimani.
Yeah, so Bimani, in terms of personal cost, so mainly the increments would come from the executives as well as the staff who are coming under the collective agreement. So in terms of collective agreement revisions, the bigger change that took place last April. So we've already accounted for that. If at all there'll be a change, there'll be an increase coming in April, but that's comparatively, that's quite small in terms of the increment that went in last year. So major part of it had already been accounted for.
There are two questions on asset quality side. Sorry, Bimani. Yeah, so if I may move on, there are two questions on asset quality side, and if I, it says in terms of stage 3 coverage, what is the optimal level in your view, and what is the increase or the decline from 75% levels? Anuradhi, would you like to respond to this?
So in terms of stage 3 coverage, I think we are in a fairly decent level. Actually, 75 is pretty high comparatively compared to where we were a few years ago. So a further increase, I wouldn't think a further increase is required unless in the current context. So if at all with recoveries and loan book improving, it may decline, but I personally don't think there'll be a need for further increase in the stage 3 coverage.
Second question for Anuradhi is that what has caused the stage 1 and stage 2 reversals when the loan book was expanding? Has there been a parameter change during the quarter?
So in terms of the parameters from a probability or LGD point of view, there had not been any changes, but from an economic factor adjustment point of view from the December position. So for December computations, we've taken the economic parameters based on the data that was available as of that particular date. Later on, central bank published the latest numbers for December. So based on that, based on the actual data for December, there had been updates to the model, but or in terms of the probability weightages and the future assessments, that those remained unchanged. If at all, the change had been based on the actual numbers.
The next question again to Anuradhi is, could you shed some light into how NII of treasury segment grew by approximately 70% year on year, despite rates coming off substantially and a shorter duration book?
So in terms of treasury NII, there is enough. So there is, in terms of treasury NII, on a year-on-year basis, last year, based on the transfer price, these are basically the internal transfer pricing, also is affected by the rates that by the market interest rates. So that has also had an impact in terms of this NII that treasury is recording.
So the next question is on LCs. If I may post this to Sanjay, what is your market share of the 450 million LCs open so far?
So we are tracking at about 20% of market share in terms of trade with a lot of our bigger customers opening LCs with us, and there is a pipeline as well for the next few months. So right now it's at about 20%.
So the next question is on HNB Finance. Are there any plans to raise the capital of HNB Finance given the company's capital is weak in comparison to peers? So if I may take this, HNB Finance did a rights issue of over 1 billion. And so they are comfortable at the levels that they have against the regulatory requirement that is there. So for the moment, we believe that the capital levels are adequate for them. So the next question is on NPLs again. Sorry, the next question is on margins. Bimal, if I may pose this to you, do you see further downward pressure on NIMs on the coming quarters?
So if you look at the market interest rate, they seem to be pretty much bottoming out. And the outcome of the last couple of bond and yield auctions has also given reason to believe that the market rates are close to bottoming out. And so the impact would see on our GSEC portfolio. Of course, we would likely see a further impact from the secondary market and on the primary option rates impacting the treasury investment portfolio. So that is unavoidable because we do have a sizable short-term portfolio in government securities. But on the loan side, we do see hope and optimism because there is credit demand picking up. And although the rates have become very competitive in the market, especially on the corporate lending side, on the SME and on the retail segments, rates are still attractive to the lender because the deposits have also, with the market interest rates, have got repriced and those benefits are accruing to our P&L. So in terms of overall margins, we don't see reversal in the trend, and we probably margins expanding in the next quarter or the quarter after next. But the pressure we have been seeing on the margins or the downward pressure for the last several quarters, maybe we are seeing that we are probably at the bottom, and the most of the repricing will be over in the coming quarter, and we'll start seeing very stable to normalized NIMs for the entire sector, not just for HNB, in the second half of the year.
So the next question again is on HNB Finance. On HNB Finance NPL ratios. So HNB Finance NPL ratios are relatively high. This is largely on account of some of the old loans that they have granted. So if you look at their current portfolio or the loans that they have granted since 2023, that portfolio, the NPA ratio remains very low at around 1%. But the legacy portfolio, if you bring it, then they are around 17%, which they are working on recovering. So moving on to the next question, what are the segment that you're growing in your loan book, and what are the segments that has higher exposure on stage 3 category? Sanjay, would you like to take this?
Yeah, so the growth segments have mainly been SME, a little bit of growth on the microfinance side as well, a lot on the retail, especially on the leasing book with both SMEs and retail customers growing their portfolio. Then on the home mortgages as well, we have been still a little careful on the unsecured personal loan side. So effectively, SME and retail has been the sort of the growth engines for the first quarter. Like I said earlier, corporate has been a little flat due to pricing sort of deals that we didn't want to get into. And in terms of the stage 3 exposure also, it is corporate and project finance that has the higher value components, fairly old ones that we have had on our books, which we are working through, but it's those two segments that have the high exposure on stage 3.
So the next question is on capital adequacy levels. If I may pose this to Bimal, HNB group level capital adequacy buffers are the highest in the industry. Am I right in saying that the balance sheet is overcapitalized? And what is your general thought on capital buffers going forward?
Yeah, so on the face of it, yes, we are carrying a lot of buffers, and that is partly, I think, largely driven by the circumstances. We had large reversals. And had a very decent year with profitability last year. So it's not out of choice. It's probably driven by circumstances. And maybe if you ask, honestly, we would prefer to maybe have a more balanced approach to our capitalization levels. But we do have some plans to deploy this capital on growth-oriented strategies, and we are hopeful once we do go ahead with those strategies, we will probably achieve a more sustainable level of capitalization, which will accrue higher or maybe above market returns to our shareholders.
So next question is on book segmentation. What is the current SME exposure on the loan book, followed by retail and corporate? Sanjay, would you like to respond to this?
So essentially about 30% or maybe 40% if you put SME and retail both together on the loan book side. But we are looking at consciously growing the SME and retail faster than the corporate side because of the margins, and obviously because of our setup having a 250 branch network, we see more opportunity on those areas. But right now it's a 60-40 split.
So the next question has two parts. I think the second part on NIMs, Bimal already responded to. So it says, how aggressive would you plan to be on growing your loan portfolio during the year? Where do you expect NIMs to stabilize? Bimal, Sanjay, Bimal, would you like to take that?
On the growth.
Yeah.
So of course, we've had a somewhat of a overall growth point of view, slow first quarter. As Sanjay explained, we did shed some of the foreign currency loans. Some were acquired by outpricing us, but we do see a very strong pipeline for the rest of the quarters for this year, and we have already started executing some of those deals in the pipeline, and we are hopeful for a very strong second quarter and a much stronger second half, and hoping to deliver a double-digit growth on the loan book as well as on the deposit side. I think NIMs we explained we are not seeing signs of the reversal in the current trend or the trajectory of the NIMs being coming down from very high levels that we saw probably 2 years ago, but we are probably seeing them stabilizing over the next few quarters. From the combined effect of your deposits getting repriced and on the credit demand driving the loan interest rates higher, somewhat offsetting the impact or the negative impact on the treasury side. Yeah.
Next question, I'll pose it to Anuradhi. On the loan book, what's the split between fixed and variable rate loans?
So it's currently around 30 to 70, 35 to 65, around that range.
There's another question on HNB Finance and their book composition in terms of the products. So I think historically, HNB Finance has been focusing on microfinance, but with whatever the changes that happen in the environment in terms of the crisis that we've been through, the COVID, the moratorium, all of that, their focus has been on basically moving on to asset-backed facilities. So especially in terms of leases and gold-backed loans. So that's where they're driving, and the majority of their exposure is more towards that segment now. So the next question again to Anuradhi. There was a sizable increase in HTM portfolio throughout the last 3 quarters. Could you shed some light where this is mainly coming from?
So this is mainly from the government securities, the T-bills and the T-bonds, and as part of what we've received through the ISB restructure, those are also contributed. So that is contributing to this growth over the last few quarters.
So the next question, I'll pose it to Sanjay. What is the average LTV and interest rates on mortgage loans?
So the LTV ranges, in the space of 60 to 70% on the home mortgages. In terms of rates, shorter tenor, we are starting at about 9.5, going to about 12. That's the window we are playing with. The higher, longer tenor, the 10-year is at about 12, 12.5, and the 3-year at about 9.5 to 9.99.
So next question is also to Sanjay on corporate and retail segments. How has the credit demand and sentiment been in the first 5 months of 2025?
So like I mentioned before, I think extremely good, especially on the retail side, leasing, mortgages, extremely healthy pipeline and conversions as well, especially with the vehicles coming in. And on the SME side as well. Corporate too, there is a lot of demand, but like I mentioned before, we are conscious about margins and trying to operate, where we want to sort of, where we are happy with. So I would say all three segments, there is very sort of significant demand for lending, and obviously most banks, including us, have a lot of liquidity. So, everyone is trying to see how we work through sort of quality credit portfolios to, get some decent growth on the loan side.
So next question has two parts to it. First part I'll pose to Sanjay and the second part to Anuradhi. What is the exposure on the apparel sector, especially the segment which are exposed to USA exports, given the current uncertainties around the USA tariffs? And the second part is, have you done any special provisioning or planning to increase the provisioning on these loans?
So we haven't had a huge exposure to the garments. Some of the big companies that are operating in Sri Lanka work mainly with some of the bigger sort of state banks because of size of DLCs that they require. And we have done, however, sort of a thorough analysis of our customers in the sort of the garments trade, and looked at each one's position, situation, and the challenges they face. And we are quite comfortable with where we are operating right now. And in fact, some of the customers, we are even looking at, probable expansion of the lines in where we see them operating in other markets other than the US as well.
So in terms of provisioning, like Sanjay mentioned, we've done the analysis, we've gone through a detailed impact assessment. So wherever required, we've built in provisions. But other than that, whether there is a need for a further special provision would be looked at, also considering the industry point of view.
And the next question, I'll pose it to Bimal. How would HNB look at enhancing its current market share, which has been largely static over the last several years?
Yeah, so the market has been pretty much constant. I mean, that has probably been the case for most of the players. But we are aware of the situation, and we do have plans to increase our share of the banking assets. So on the three books, if you look at on the corporate side or the large corporate side, we are of course limited by the single SPLs. So we are, as an alternative, we are looking at taking on risk or exposures overseas. We are looking at South Asia, Central Asia, and some other exposure that we are comfortable with even in Africa. So that will drive our large corporate lending. We are also conscious of the margin pressure on the local lending, especially on the large corporate side. So whatever we do, even the growth would have to come at decent margins, must be portable and accretive. So we are conscious of those. And on the SME side, of course, we do see a lot of potential. We've been a very strong SME focused bank, microfinance focused bank, and we see SME sector, coming out of its troubled days, trying to expand its capacity, manufacturing capacity on the agriculture lending side. So we will position ourselves very strongly, given our roots, our strengths, to increase our market share in those markets, in those segments. And then on the retail side again, I think for the last 14-15 years we have been ranked the best retail finance company, and that is for a reason. We have a very strong franchise, very strong proposition to our retail customers. So we will continue to grow those books. And so that's on the core business side, and we will, given our very healthy capital levels, we will continue to look for many opportunities, acquisition of portfolios if there's anything up for sale. So those are also in our mind to increase our market share.
So the next question is on foreign currency deposits. So if I may pose this to Sanjay, most of the deposit growth came from foreign currency deposits. What is the main source country of these deposits, and what are your future plans on foreign customers, clients?
So I think there was a mix of Sri Lankans living overseas also getting more confidence. If you recall, maybe a couple of years ago when the country was going through tough times, there wasn't a lot of inflow coming in terms of remittances, in terms of others sending their salaries back to Sri Lanka. So a lot of it has come from people gaining more sort of confidence in the country. So we've seen increasing number of remittances, both from the exchange houses, the smaller value ones, and then the bigger value sort of FCY coming in for investment as well. Some activity going into the share market also through Sri Lankans living overseas, and as well as some of our corporates also bringing in their deposits on the foreign currency side. Even on the rupee side, I agree, it has been relatively flat again consciously. We have grown both the retail and the SME side, but some of the high cost deposits that we had on the corporate, we have let go because obviously the rates have been coming down. So that's the reason why you see a flattish sort of movement on the deposits. But if you look at the particular segments, we are very happy with our growth on both the retail and the SME side.
So are there any further questions? There's a question on NIMs. So HNB commands a higher NIM compared to most of the peers. How did HNB manage to do so, given its higher exposure to corporate loans, 60%, which typically generate lower yields? So if I may take this, so if you look at our book, I think historically our exposure has been more towards retail SME sector, but with whatever the changes that happened in the market, especially over the last 5 years, we've been more skewed towards the corporate side. So I think right now probably we are around 45-55%. So this exposure that we have on the retail SME side and the micro side. So I think we are a pioneer in terms of microfinancing as well. So these factors have been one of the key reasons for HNB's NIMs being relatively higher compared to the peers, even in the past. So that will be a segment, I think Sanjay and Bimal both alluded to it. So even going forward, those would be segments that we will continue to work on. So moving on to the next question, where is credit mostly deployed to? Rollover, working capital requirements, or long-term financing? Sanjay, would you like to respond to this?
Yeah, so there is a mix. I think initially first few months was more working capital, and obviously, like I said, the corporates adjusting or taking, shifting around some of the facilities based on rate. But towards maybe the last second half of the quarter, with the rates stabilizing, maybe bottoming out, we see now more interest for slightly longer tenor funding, say between 2 to 5 years is what we are seeing. And clearly on the home mortgages side, sort of the 10-year rate has been more sort of attractive to our customers. So, yeah, I mean, essentially from more working capital at the start to now more term funding is what we are seeing.
The next question, the next two questions I'll pose to Bimal. What is your appetite for equity investments as an asset class, given a low interest rate environment?
Well, we do have a portfolio of equity investments. Some are more short-term trading nature, and a large part of that is actually almost strategic investments. But as a bank that is known for being a highly successful commercial bank, we would continue to focus on our core banking business than trying to manage an equity portfolio. And we do have an investment banking arm, which we related as 100% own entity now. And through the investment banking arm, of course, we would like to explore those capital market options and get the flavor of equity investments or wealth products. But that is more for the investment banking arm and not for the commercial banking operation.
So the next question is, what is your ROE expectation in the medium term?
So we do have a internal expectation of maintaining a minimum ROE of about 15%. We are right now probably at the high teens, but once market interest rates keep adjusting to the government security market and the yield curve adjustments, high teens may not be sustainable over a medium to long term. Of course, our expectation on ROE will also move with where the risk-free rate will be, and given the market risk, what sort of a premium that we will have to probably return to our shareholders over the risk-free rate. So internally the threshold we will be looking at is maintaining a minimum of 15% ROE for the medium.
So the next question is related to cost to income ratio and digital initiatives. What is the ideal cost to income ratio of HNB in the long run, and any digitalization initiatives in the pipeline that may benefit the cost to income ratio? So probably in terms of the cost to income ratio, Bimal, would you like to come in there?
Yeah, so I think cost to income ratios get slightly distorted with some of the line items that we've had, especially in the last year, when you have exceptional items. But what probably we saw in the first quarter of this year is more of a normalized cost to income ratio, but there is still, I would say, room for improvement through the efficiency that we can bring in through tech and digitalization. So those are some of the medium to long term initiatives, but I would say where we were at end of first quarter is more a normalized level what we can expect in the medium term.
Sanjay, would you like to basically talk about any digital initiatives?
Yeah, so I think over the last few years, especially post-COVID, we've been consciously investing on sort of digital assets. Our mobile banking is one of the highest rated on both stores. A lot of activity there, including opening accounts without coming to the bank. You can do your FD investments, all your transfers, bill payments, everything. We are just looking at even cashback loans coming. So fair amount of digitization on the retail side, supporting saves on the cost in the future. And then we also have our wallet, which supports getting sort of new generation youngsters coming in, plus again looking at the payment space. So those are on the retail side. Then we also invested in SME and corporate on the transaction banking platform. Quite a lot of customers have been onboarded there. About 2 days ago, we expanded that to support trade as well, online trade for our corporate customers and SME. So these are clear sort of strategies of ours to look at how we digitize a lot of our workflows. It's a continuous effort for us to see the customer journeys that are happening at our branches and then try to see how we put that into our digital streams to support our customer journeys. And good to see the clients also now consciously moving to digital channels themselves, both on retail and corporate, and enjoying sort of the convenience of banking at their office or at their home. So we see the investments paying off, and obviously we will continuously see how we expand those assets.
So there is a question in terms of credit growth and what are the sectors from where we see growth coming from. Sanjay, would you like to take that?
So we are looking at probably a 15 to 20% growth in terms of our loan book. The bigger sort of growth areas in terms of percentage growth would be retail and SME that we are really focusing on this year. We see a lot of opportunity there. Also, our sort of import and export customers on the corporate side, and wherever the pricing makes sense to also grow the corporate book. As Bimal mentioned earlier, there are some deals we are doing in the overseas markets in terms of lending, so that we will continue to grow. So really looking at actually probably about a 20% is our expectation in terms of the loan book growth.
There is a question on proposed investment that we had in Bangladesh. So if I may pose that to Bimal, what was the reason for not going ahead with the proposed acquisition of Bank Alpala?
Yeah, so this is something that the bank announced. I think it was in the third quarter of last year that we went public with our interest to acquire the Bank Alphala's Bangladesh operations, subject to, of course, the due diligence. And so we did a lot of work in carrying out the due diligence, post the approvals that we received from the two central banks in Pakistan and Bangladesh. But of course, we were conscious of the fluid political situation and the impact that the political uncertainty had brought to the economy of Bangladesh. Although we are still pretty bullish and optimistic about the growth prospects of the country, we were concerned about the immediate impact and especially the uncertainty, given there had not been an elected government, and there is a bit of uncertainty over when the elections would be. So given those, we want to take a bit of a cautious approach towards that investment. So we are still, bullish about that market, but we felt timing-wise, maybe it's a decision that maybe we should maybe defer and reconsider and reevaluate maybe once we see a bit more stability on the political side. It's still a very large and a high growth market. Maybe when we see a bit more stability on the political front, and when we see an elected government and some sort of consistency in policy making, we would relook at an investment. May not be the target that we had in mind, but it could be the same target if that's still available, or maybe a different target we would look at. So it was more of a case of being cautious about the country's prospects. In hindsight, of course, after we made the announcement, the world was hit by the Trump tariff, which also could have a very serious ramification on the Bangladesh economy, given that they're reliant on garment exports. So we will continue to watch the developments on that front and see whether there is an opportune time for making an investment in that country.
I think there's a related question, and I think Bimal partly answered that as well. Is the overseas operation expansion still on the cards? Are there any other destinations other than Bangladesh? Will it be similar operation like Sri Lanka, if so?
Yeah, so the strategy is still intact. We are looking at opportunities. We have enough capital buffers to deploy if we come across attractive enough opportunity. So it is still intact. We are still looking out. There is still a lot of interest at the board level, at the shareholder level, to explore these growth opportunities. And it would not be limited to Bangladesh, but we are still, as I said in my previous response, we are not completely shut our doors on Bangladesh. We will also look at other markets in Asia, as well as in other continents where we see that will deliver us a higher return. And if we do go into those markets, it will be mostly, at least in the initial stages, will be on the commercial banking side, something similar to what we do here.
So there's a question on whether we are keen on looking at the Standard Chartered retail business. We are. I mean, we've had conversations with their regional team, and we are exploring, that possibility. We're going through the data. It's a relatively small portfolio that they have here, but considering the segments that they're operating in and that alignment to HNB, we will sort of show our interest in that portfolio.
So are there any further questions? If there are no further questions, thank you very much for joining our first quarter update. We look forward to talking to you again at the end of the second quarter. Thank you very much. Have a good evening.
Thank you.
Thank you.